What are synthetic positions using options contracts? Imagine you want to invest in a commodity without actually buying or selling the physical item or futures contract. That's where synthetic positions come into play. They let you mimic the payoff of other investments using options. These strategies are built by combining different options contracts, sometimes with the underlying asset, to create a similar risk and reward profile. Let's start with the basics. Synthetic positions are based on a principle called put-call parity. This principle says that certain combinations of call options, put options, and the underlying asset will have the same value and payoff as other positions. For example, if you buy a call option and sell a put option with the same strike price and expiration date, you create a synthetic long futures position. This means you profit if the commodity price rises and lose if it falls, just like holding a futures contract. On the flip side, a synthetic short futures position involves buying a put option and selling a call option with the same strike and expiration. This setup mimics the payoff of a short futures contract, which profits when prices drop. These synthetic futures give investors an alternative way to participate in commodity price movements without directly trading futures, which can sometimes require higher margin or involve more complexity. You can also create synthetic stock positions. For example, buying a call option and selling a put option on the same underlying and strike price can simulate owning the stock. This approach lets investors gain exposure without actually purchasing the stock. The same idea applies to commodities or commodity-related stocks, giving flexibility in how you participate in the market. Using synthetic positions offers many benefits. They give investors flexibility to adjust their exposure to commodity prices without entering the futures market directly. Creating these positions often costs less upfront compared to buying futures or physical commodities. They also allow for tailored risk and reward profiles by choosing specific strike prices and expiration dates. Plus, investors can switch between long and short synthetic positions easily as market views change, without closing out physical futures contracts. But it's important to remember that synthetic positions come with risks. Since they rely on options, they are affected by time decay, which reduces the value of options as expiration approaches. Changes in implied volatility can also impact their value. If the market moves against your synthetic position, losses can accumulate similarly to traditional futures or stock positions. In summary, synthetic positions using options contracts are constructed combinations of calls, puts, and sometimes the underlying asset that replicate the payoff of futures contracts or stock ownership. For those investing in commodities, these strategies provide alternative ways to gain exposure, offering more flexibility and potentially lower capital requirements. Just keep in mind that managing option-specific risks is key to making these strategies work well.